Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss the Alphabet split and the effect that it has on options. Steve, it's great to see you as always. Welcome back to Trade Talks.
My pleasure as always, Jill. Great to see you.
And Steve, it's so interesting when we think about stock splits, the first thing that comes to mind is, oh, how does that impact valuations? Well, it really doesn't, but it also has an impact on the options. Tell us more about that.
Yeah. I've never been a huge fan of stock splits as an investment strategy, because effectively it's the market's way of making change. You have a $20 bill before, now you have 20 singles afterwards. In the case of a 20-for-1 split, you can argue there's more utility to have the smaller bills, but that in an era where fractional shares are in place and popular among most investors and investment firms, the affordability argument doesn't mean that much, but it does in the underlying stock. In the options, it really does, and it's a matter of simple math. What happens is, in both cases, and again, I'm just going to keep referring to Google's 20-for-1 split. In Google's case, you have a stock that's $3,000, and let's say you had 100 shares at $3,000. Well, then you'll have 2,000 shares at $150 a day after the split. I'm sorry, scratch this. 2,000 shares at $150 post split. Either way, it's $300,000. It does make it marginally more affordable to buy the stock. But the interesting thing is, options, you're limited by contract size. You can't get smaller than one contract, which represents 100 shares. So in the case of Google, where I'm looking, let's say, at a February at-money option that's trading around $60. Again, this is going to be in July, but let's just flash forward a bit.
Mm-hmm.
So if we take these options, the minimum cost of entry for me to buy an at-money February option in Google, at-money option in Google right now, is one contract at $60 a contract. That's $6,000. When this splits, you're going to have the strike space being 20. You're going to have the strikes being priced 1/20th as well. So the $3,000 at-money option is a 150 option. If you're long the options over that period, you've got 20 times more. But the key is, at that point, the $60 option is going to be about a $3 option, which means you can buy a contract for $300. You can buy 20 contracts for the same $6,000. So this makes the option trading profoundly more available to individual investors. The other thing is, now spreads will come down too commensurately. So right now, where we're seeing fairly wide spreads, $1.50, we're going to see things like a nickel to, somewhere between a nickel and 7 cents maybe on these same strikes. I would expect the spreads actually to tighten more than 1/20th by a factor of 20, because there'll be more activity, there'll be more volume, there'll be tighter spreads if more people are trading them. It just gets easier. So that's a real boon to option traders, and that's the thing that we really want to be looking at in terms of having the split make this much more profoundly affordable to individual investors. Quite honestly, it's not going to hurt the exchange volumes either,
Right.
but it's just going to make it much easier and cheaper for everyone to trade options. Your cost of entry is going to be much lower.
So Steve, is there an actual strategy around this, an arbitrage, if you will, when stock splits occur because of the math behind all of this?
Not really. We used to actually, back sort of in the early days of our option trading, we did actually used to put in sort of what we would call a split boost. That was sort of a 90s thing where, we could expect that they would get more volatile after they split and became more affordable. Remember, that was when things tended to trade in round lots, not odd lots, and certainly you didn't have fractional shares. We actually stopped using that several years ago. We didn't find that there was a meaningful change to the volatility. I just think that what it means is you can now adopt strategies that are a bit more affordable. You can get more granularity. You can get a lot more you can do spreads that that are easier to achieve because you're not necessarily locked in by this relatively high cost of entry. You can trade multiple contracts for the same amount that you did before, which means you can tailor spreads more effectively. One thing to keep in mind is the strike space is already fairly tight. In certain cases, you have $5 increments on a, call it a $3,000 stock. That's going to get down to, let's say, quarter instruments after the split, which I think is something to tell the people who keep the strike spaces going, maybe not keep the $5 options going through July, past July, because we don't want to have too many strikes out there. And creates quote traffic and confusion. But the strategy, if you're a spreader, if you like to do, one line versus another, particularly a couple of, multiple leg strategies, this is going to tighten spreads. It's going to increase your contract sizes and increase your flexibility. I think that's a boon.
And Steve, to wrap up here, I know you've been asked quite recently, VIX and VXN, they've been relatively stable, but we keep hearing about all this volatility in the market. What are your thoughts there?
There's a lot to unpack in that. First of all, I mean, we saw most of the volatility indices, double from mid-January through the end of the month, early February, and then started to come down, and now they're back up a bit, but not nearly to the level they were. We have washed some of let's say the real panic out. The tricky thing about watching the big volatility indexes, and you could take your pick here, whether it's VIX, VXN, VolQ, this applies more or less to all of them, is in earnings season, you find that stuff goes in, one direction or another. I mean, just take a look at the varied response to, the 5 names in FANG, 2 of them down 20%, the other 3 up 10% after earnings, give or take. And over individually that creates some volatility, but over time, as you're watching earnings come and go, which were thick of earnings season, they tend to balance out. I traded bank stocks for many years. It was very frustrating because XLF would sort of sit there because one bank would go up and the other would go down and the index would stay unchanged. So I think we need to sort of work through earnings season to get what I'm going to call a clearer read on volatility. On the larger indices, we've worked through the panicky stuff that we saw late January, where we saw a backwardation in the volatility structure or in the VIX futures curve. But we're now going to start to, I think we're going to stand on our own 2 feet. That doesn't mean that volatility comes down. I think if anything, today's numbers argue for potential for more aggressive action from the Fed, which can produce volatility. But I think we're through the worst of earnings season, which even then, with these huge numbers, they often balance themselves out when you're starting to look at indices that are that have a 30-day time horizon.
All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much, Jill. Talk soon.